Disclaimer.
Just happened. 3 days ago, Supreme Court killed $175 billion in Trump tariffs. Gone. 4 hours later, new tariffs, 15%, on everything. Meanwhile, Iran has 10 days. 2 aircraft carriers are in position. Gold just hit $5,142. Silver holding above 84. So here's my question for you. What are you doing today? Because if you think this is just another news cycle, another political drama that blows over by next week, I need you to pay very close attention to what actually happened. This isn't noise. This is the sound of 2 ticking clocks, and both of them affect your money. Let's break down Friday, February 20th. Roberts plus 5 justices looked at Trump's tariff program and said one word. No. 6-3. Done. The legal foundation for every IEEPA tariff collected since Liberation Day? Vapor. Think about that number for a second. $175 billion sitting in Treasury accounts right now with a giant question mark over it. Who's getting that money back? Not you, not me, the importers who paid the customs bills, even though we paid the higher prices at Walmart, at Home Depot, at the car dealership. That refund isn't coming to our mailboxes. It's going to corporations. The Treasury has to figure out how to cut those checks while already running a $2 trillion deficit. Think Trump gave up after that ruling? Think he accepted defeat and moved on? Mistake. 4 hours. That's all it took. Same Friday afternoon, new proclamation hits. Section 122 of the Trade Act of 1974. Pop quiz. Who here had heard of Section 122 before this weekend? Nobody. Because no president in 50 years ever touched it. It sat there in the statute books, gathering dust, waiting for exactly this moment. What does it do? It gives the president power to slap 15% tariffs on everything for 150 days. No Supreme Court approval needed, no congressional vote. Just executive action and a ticking clock. Friday evening, 10% tariffs announced, effective Monday. Saturday morning, Trump posts on Truth Social, 15% now, maximum allowed. By the time you woke up Sunday, America's entire trade framework had been rebuilt from scratch. Here's what the market heard. Uncertainty. And here's what uncertainty does to capital. It runs. Where does it run? Toward assets that don't care about court rulings or presidential proclamations or congressional gridlock. Gold doesn't need permission from 6 justices. Silver doesn't wait for Truth Social updates. But wait, we're not done. Because while our constitutional system was doing backflips over tariffs, something else was happening 6,000 miles away. And this part should really grab your attention. 10 days. That's the deadline Trump gave Iran last Thursday. Maybe 15, maximum. His words, not mine. 10 to 15 days to make a deal on nuclear weapons and missiles, or else what? Look at the Persian Gulf right now. USS Abraham Lincoln Carrier Strike Group has been there since January. That's 5,000 sailors, 60-plus aircraft, guided missile destroyers. Now add the USS Gerald R. Ford steaming in from the Mediterranean. Largest warship ever built. Together, 40,000 American military personnel converging on waters within striking distance of Iran. Does that look like negotiation positioning to you, or does that look like preparation? The Iranians bombed our base in Qatar last summer after we hit their nuclear sites, killed Americans. Do you think they'll just roll over now? Their foreign minister went on television and said, zero enrichment is off the table, period. Non-negotiable. They'd rather take the hit than surrender their nuclear program. So where does that leave us? 2 scenarios. Either a deal nobody expects, or escalation everybody fears. There's no comfortable middle ground when aircraft carriers are in position and deadlines are measured in days. 10 days. Where's your plan B? Let me connect these 2 crises for you, because this is what most people are missing. The tariff chaos means $175 billion in potential refunds that Treasury wasn't budgeting for. That's fiscal pressure on a government already drowning in debt. The Iran situation means oil shipments through the Strait of Hormuz could get very complicated very fast. 20% of the world's oil flows through that choke point. Both crises point the same direction. Both say the same thing to anyone paying attention. The systems we've relied on for stability are under stress, real stress. Not theoretical, not someday, not maybe. Right now. You know who figured this out before we did? Central bankers. Not our Federal Reserve, mind you. The ones in Poland, China, India, Turkey. They've been buying gold at a pace not seen since the 1960s. Over 800 tons last year alone. They're not buying because gold is pretty. They're buying because they see what's coming. Gold at $5,142 today isn't a bubble. It's a signal. Silver above 84 isn't speculation. It's recognition that the old rules are changing. Here's what I want you to understand about this moment. The Supreme Court ruling and the Iran deadline aren't separate stories that happen to occur the same week. They're symptoms of the same underlying condition. a global system under pressure from multiple directions simultaneously. Tariff timer, 150 days until Section 122 expires or Congress acts. Iran timer, 10 days until the deadline Trump set. Refund bomb, $175 billion Treasury may have to cough up. Deficit reality, $2 trillion and climbing. Every single one of these factors supports the same trade. Every single one says the same thing about where capital wants to flow when the foundations feel shaky. I've been covering markets for a long time. I've seen rallies built on hype that collapse when reality hits. This isn't that. The buying pressure in gold and silver right now is coming from institutions with decades-long time horizons. Central banks don't panic buy. Sovereign wealth funds don't chase momentum. When they move capital into precious metals at this pace, they're making a statement about the next 10 years, not the next 10 days. So let me ask you again. 2 clocks ticking. 150 days on tariffs, 10 days on Iran. Aircraft carriers in the Gulf, Supreme Court rulings reshaping trade policy overnight. Treasury scrambling to figure out refund logistics while running historic deficits. Gold blazing past 5,000, silver holding strong above 84. What's your move? What are you doing today? Because here's the thing about moments like this. They don't send invitations. They don't wait for you to feel ready. They happen, and then you're either positioned or you're not. In the next section, I'll show you the actual numbers behind this rally. The central bank purchases that keep accelerating even at these elevated prices. The data that proves this isn't speculation, it's structural change in how the world views American assets. And I'll explain why silver's industrial profile creates an additional dimension of value that most investors haven't even begun to appreciate. The proof is in the data. Let's look at it together. All right, you've heard the headlines. Tariff chaos, Iran countdown, gold blazing. But headlines don't make investment decisions. Data does. So let's get into the numbers that actually matter, because what I'm about to show you separates this rally from every other precious metals spike you've seen in your lifetime. Gold closed Friday at $5,062, pulled back slightly over the weekend. Right now, $5,142. That's a dip from the $5,164 high we touched last week. You know what most people see when gold dips? Weakness. You know what I see? Buyers lining up. Here's the number that should stop you cold. Plus 6% month to date. February isn't even over. 6% in 3 weeks on an asset that's already up over 70% from last year. That's not a spike. That's not a squeeze. That's institutional money flowing in with both hands. But wait, didn't gold already have its run? Isn't $5,000 the top everyone predicted? Isn't this where smart money takes profits and goes home? Let me show you what smart money is actually doing. Central banks, the biggest, most conservative pools of capital on earth. The institutions that move on 10-year timeframes, not 10-day trades. What did they do in 2025? They bought 863 tons of gold. Not the highest year on record, sure. 2022, 2023, 2024 all topped 1,000 tons. But here's what matters. They kept buying even as prices doubled. Read that again. Gold went from 3,000 to 5,000, and central banks didn't slow down. They didn't take profits. They accumulated. Who's leading this charge? Not us. Not the Federal Reserve. We're sitting on our 8,000 tons like it's a museum collection. The action is in emerging markets. Poland bought over 100 tons last year alone. Their central bank governor went public in January saying he wants 700 tons total for national security reasons. His words. China added to reserves for 15 consecutive months through January. Their holdings now exceed 2,300 tons. India, Turkey, Czech Republic, Brazil, Kazakhstan, Uzbekistan. Every month, the World Gold Council releases data. And every month, the same pattern, emerging market central banks buying. Why? What do they know that we don't? Here's the answer. Nobody in mainstream financial media wants to say out loud. They're diversifying away from us, away from dollars, away from treasuries, away from an American financial system that freezes foreign assets when it doesn't like your politics. Remember what happened to Russia's reserves in 2022? $300 billion, frozen overnight. You think central bankers in Beijing and New Delhi and Ankara didn't notice? You think they're not asking themselves, could that happen to us? Gold can't be frozen. Gold can't be sanctioned. Gold doesn't care who the American president is or what the Supreme Court decides about tariffs. That's not a conspiracy theory. That's the actual, stated reason these institutions are buying. The World Gold Council surveyed central bankers last year. 95% said they expect global gold reserves to increase over the next 12 months. 95%. When's the last time 95% of anyone agreed on anything? Now let's talk about the number most analysts are getting wrong. You'll hear estimates that central bank buying will slow down in 2026. JP Morgan says 755 tons. Others say even less. Their logic? Higher prices mean banks don't need as many tons to reach their target allocation percentages. Sounds reasonable, right? Here's the problem, that math assumes central banks are targeting a fixed percentage. But what if the target itself is moving? Poland raised its gold target from 20% to 30% of reserves. Then their governor said he wants more. China hasn't published an official target, but their buying pace tells you everything. These aren't institutions hitting a number and stopping. These are institutions in accumulation mode with no visible ceiling. Through October 2025, reported central bank purchases hit 687 tons year to date. But here's the kicker. That's only reported purchases. The World Gold Council estimates actual buying is significantly higher because some central banks, particularly China, don't report all their acquisitions to the IMF. 687 tons reported. Real number? Nobody knows. But the gap between official data and actual flows keeps widening. So when someone tells you central bank demand is slowing, ask them, slowing compared to what? Compared to the 1,000-ton years? Sure. Compared to any year before 2022, we're still running at nearly double the historic average. And that's at $5,000 an ounce. Now let's talk silver, because this is where it gets really interesting. Silver at $84. Up over 160% from a year ago. More volatile than gold, absolutely. We saw it spike above 110 in late January, then crash back down. Treasury Secretary Bessent blamed Chinese speculators. Maybe he's right. But here's what that volatility is hiding. Silver has a structural supply problem that gold doesn't have. Gold is money. Almost all the gold ever mined still exists somewhere, in vaults, in jewelry, in your grandmother's ring. Silver gets consumed. Industrial demand eats supply, solar panels, electronics, medical devices, electric vehicles. Every technology trend you've heard about for the next decade needs silver. The Silver Institute reported a structural deficit last year. Demand exceeded supply, again, 4th consecutive year. And here's what should really get your attention. That deficit is growing, not shrinking. Now, layer on the tariff situation. Remember those Section 122 exemptions I mentioned? Critical minerals made the list. Silver is a critical mineral, which means while 15% tariffs hit most imports starting today, silver flows more freely. Why does that matter? Because it makes silver relatively more attractive compared to other commodities getting tariffed. Money that might have gone elsewhere has one less friction point flowing into silver. The gold to silver ratio right now sits around 62 to 1. Historic average? More like 50 to 1. Some analysts argue it should be even lower given silver's industrial demand growth. If that ratio compresses toward 50 while gold holds above 5,000, do the math yourself. That's silver well above $100. But forget the ratio for a second. Let's talk about what silver is doing that gold can't do. Gold is a monetary metal, period. Its value comes from being money. Silver? Silver is both, monetary metal and industrial commodity. It's playing two games at once. When safe haven demand spikes, silver benefits. When industrial demand grows, silver benefits. When both happen simultaneously, that's right now. Solar installations are projected to grow 40% this year. Each gigawatt of solar capacity requires approximately 20 tons of silver. Electric vehicle production keeps climbing despite tariff uncertainty. Medical technology demands more silver for antimicrobial applications. 5G infrastructure build-out continues globally. Every one of these trends existed before the tariff chaos. Everyone existed before Iran's deadline. They're not going away regardless of what happens in the next 10 days or 150 days. Gold catches the headlines. $5,000 sounds impressive. But silver's percentage gains have actually outpaced gold over the past 12 months. The industrial floor underneath silver demand means even if safe haven buying cools off, structural deficit persists. So let's recap the proof. Central banks, 863 tons in 2025, still buying at $5,000 prices. Emerging markets, leading accumulation, diversifying away from dollar assets. Gold, 5,142 today, up 6% in February alone. Silver, $84, 160% annual gain, structural supply deficit. Tariff exemption, critical minerals including silver excluded from Section 122. This isn't speculation. This isn't momentum trading. This is institutional capital making a long-term statement about where value lives when traditional systems face stress. Next, let's do the calculation. The staircase rally ahead. What the 150-day tariff clock and the Iran binary mean for price targets. And why March 15th might be the date circled on every trader's calendar. The math gets very interesting from here. All right, you've seen the setup. You've seen the proof. Now let's do what most financial media won't do. Actual math. Real projections. Specific dates. Because when you stack the catalysts, run the timelines, and calculate the flows, a picture emerges that should inform every decision you make between now and April. 2 clocks, 150 days on tariffs, 10 days on Iran. Let's calculate what happens when they converge. Start with the tariff refund bomb. $175 billion. That's not my number. That's the estimate from budget analysts tracking every IEEPA customs payment since Liberation Day. Treasury collected it. Courts now say Treasury shouldn't have. So what happens next? Refunds. Massive refunds to importers through a process that doesn't even exist yet. Think about the logistics for a second. Customs and Border Protection has to build a refund mechanism from scratch. They have to verify claims going back to February 2025, process paperwork for thousands of importers, cut checks to companies ranging from Walmart to the small business owner who imports specialty goods from Vietnam. How long does that take? Who handles disputes? What happens when an importer already passed the tariff cost to consumers and pocketed the markup? Nobody knows. The court didn't address refunds. The executive order revoking IEPA tariffs didn't address refunds. The whole mess got kicked back to the Court of International Trade to figure out. And that court has to work with Customs and Border Protection, which operates under the Department of Homeland Security, which is currently caught in budget gridlock limbo. You seeing the problem here? This isn't a clean unwinding. This is bureaucratic chaos layered on top of fiscal pressure. So when do those refunds actually flow? Could be months, could be years, could get tied up in litigation until 2028. But here's what matters for markets. Treasury has to account for that liability now, today, on the books. $175 billion is a potential outflow, against a deficit already running $2 trillion annually, against interest payments on the national debt that now exceed what we spend on defense, against a Congress that can't agree on a lunch order, let alone fiscal policy. That's not neutral for gold, that's rocket fuel. Why? Let me walk you through the chain. Deficits mean borrowing. Borrowing means Treasury issuance. More Treasury issuance means more supply of government bonds hitting the market. More supply means either higher interest rates to attract buyers or Federal Reserve intervention to absorb the excess. Higher rates crush economic growth. Fed intervention expands the money supply. Either path pressures the dollar. Either path makes hard assets more attractive. Either path supports gold. Where does money hide when the fiscal plumbing looks stressed? You already know the answer. The same place it's been hiding for 5,000 years. Now layer on the Section 122 clock. 150 days starting February 24th. That's today. The clock started ticking this morning. It runs until late July. But here's what most people miss. Congress can modify or extend these tariffs at any time. The president can negotiate exemptions. Trading partners can retaliate. 150 days of uncertainty about whether tariffs stay, go, increase, decrease, or transform into something else entirely. 150 days where every importer, every manufacturer, every retailer has to make decisions without knowing the rules. Markets hate uncertainty more than they hate bad news. Bad news you can price and move on. Uncertainty? That's a tax on every transaction, every supply chain decision, every capital investment. And that tax gets paid in risk premiums flowing toward safe havens. Can you run a business when the import costs might change by 15% in either direction based on a Truth Social post? Can you sign long-term contracts? Can you commit to inventory? The answer is you hedge, you protect. You move capital toward assets that don't depend on political whims. But the real wildcard isn't the tariff clock, it's the Iran clock. And this is where the calculation gets binary. 10 days, Trump's deadline, maybe 15. We're now inside that window. By the time you're watching this, we might be down to single digits. The IAEA board meeting starts March 2nd in Vienna. 10 days from Trump's Thursday announcement lands right in the middle of that meeting. Coincidence? What happens when the clock hits zero? Scenario 1, deal. Iran accepts zero enrichment, dismantles Natanz and Fordo permanently, limits ballistic missiles to 300 kilometers, stops funding Hezbollah and the Houthis. Tensions ease. Oil flows freely. Risk premiums deflate. Gold gives back some gains. What's the probability? Let's be honest, close to zero. Iranian leadership has staked their entire legitimacy on nuclear sovereignty. Their foreign minister said on international television that zero enrichment is non-negotiable. The supreme leader told supporters that America's Navy can be sunk. 32,000 protesters died in January crackdowns, and the regime didn't blink. These aren't negotiating positions that soften under pressure. These are red lines drawn in permanent ink by leaders who believe backing down means regime collapse. Scenario 2, strike. American forces hit Iranian targets. Tomahawks fly. B-2 bombers deploy. The Ford and Lincoln launch coordinated air operations. Iran retaliates against bases in Qatar and the UAE. Oil markets spike 50% overnight. Strait of Hormuz becomes a war zone. 20% of global oil supply at risk. Probability? Higher than anyone in polite company wants to admit. 40,000 troops aren't deployed for show. 2 carrier strike groups don't converge by accident. Senator Lindsey Graham, close Trump ally, told reporters, any military action has to be big enough to take down the regime. That's not surgical strike language. That's regime change language. The military infrastructure being positioned right now isn't designed for a warning shot. It's designed for sustained combat operations. Weeks, not days. And the Iranians know it, which is why they've buried tunnel entrances at nuclear sites and dispersed their remaining enriched uranium. Scenario 3, muddle. Deadline passes. No deal. No strike. Extended ambiguity. Threats continue. Military stays in position. Iran keeps rebuilding. Markets live with permanent uncertainty about when, not if, escalation happens. Probability? This might actually be the most likely outcome in the near term. And here's why it matters for your money. Muddle doesn't resolve the fear premium. It embeds it permanently. Think about what permanent ambiguity means for gold. Every day that two carrier groups sit within strike range of Iran, every day that nuclear deadlines hang unresolved, every day that 40,000 American service members wait for orders, markets have to price the tail risk of sudden escalation. That's a floor under gold prices, a floor that doesn't go away until the situation actually resolves, one way or another. Analysts estimate this embedded fear premium at roughly 5% on current prices, 5% above where gold would trade on pure monetary fundamentals. Sounds small. On a $5,000 base, that's $250 per ounce of geopolitical insurance, baked in every single day. And that premium doesn't deflate until someone blinks. Iran or America. Right now, neither side is blinking. So let's build the staircase. Here's how the rally projects forward, step by step. Step 1. Now through early March, Iran deadline window, maximum uncertainty, fear, premium fully engaged. Gold holds above 5,000 with spikes on any headline suggesting military action. Silver rides the momentum. Industrial demand providing structural floor support, even if sentiment wobbles. Watch the news flow. Any report of aircraft launching from carriers, any satellite imagery of military movements, any statement from Tehran that sounds like defiance. Each headline is a potential catalyst for the next leg up. Step 2, March 15th. Circle this date. Why? The IAEA board meeting starts March 2nd in Vienna. 5 days of deliberations about whether to formally censure Iran and refer the matter to the UN Security Council. By mid-March, we'll know whether the diplomatic track still has a pulse or flatlined. If diplomacy fails publicly, if referral happens, if military posture tightens further, that's your breakout window. Gold pushes toward 5,400, silver tests 90. The staircase takes its next step up. Remember, Secretary of State Rubio is scheduled to visit Israel on February 28th, 2 days before the IAEA meeting. You think that timing is accidental? You think he's going to Jerusalem to discuss tourism? Step 3, April 1st. Q1 ends. Central bank reserve data gets reported to the IMF and World Gold Council. This is when we find out whether the buying pace accelerated or decelerated in the first quarter. Here's the key number, 300 tons. If central banks bought 300 tons or more in Q1, that's above the quarterly run rate from 2025. That's acceleration at $5,000 prices. That's a signal to every institutional investor on Earth that the biggest, most conservative money in the world is still accumulating. 300 tons in Q1 sets the narrative for all of 2026. It tells markets this isn't a trade, it's a trend. And trends at this scale don't reverse on a dime. Goldman Sachs has a year-end gold target of 5,400. They've called this rally correctly for 2 years running. UBS says 6,000 is achievable under their upside scenario, citing geopolitical tensions and central bank flows. Societe Generale analysts said recently that 6,000 might look conservative in hindsight if military strikes happen. These aren't Reddit speculators. These aren't gold bugs talking their book. These are the institutions that move markets, telling you in plain language where they think this goes. What could break the staircase? What's the bear case? Let's be fair and examine it. A genuine Iran deal that removes the fear premium overnight. A Supreme Court reversal that reinstates IEPA tariffs and eliminates refund uncertainty. A coordinated central bank selling program that reverses 3 years of accumulation. A sudden surge in mine supply that floods the market. A stock market rally so powerful it pulls all capital back into equities. Now ask yourself honestly, do any of those sound likely? Iran isn't surrendering its nuclear program to a president they consider an existential threat. The Supreme Court isn't reversing a 6-3 decision 3 days after issuing it. Central banks aren't suddenly deciding they own too much gold after buying for 3 consecutive years at record pace. Mine supply takes years to increase meaningfully. And the stock market, it's navigating the same tariff chaos and geopolitical uncertainty that's driving gold higher. The bear case exists on paper. It doesn't exist in reality, not right now, not with these catalysts stacked this way. The path of least resistance is up. The only question is how fast and how far. So here's the bottom line. Here's what I want you to take from everything we've covered today. Gold at 5,400 by April, First isn't fantasy. It's the mathematical output of central bank demand continuing at current pace, fear premium staying embedded through Iran uncertainty, and tariff chaos providing a fiscal backdrop that favors hard assets. The inputs are known. The calculation is straightforward. Silver at $90 isn't speculation. It's the gold to silver ratio compressing toward historic norms, while industrial demand from solar, EVs, and electronics creates a structural floor that doesn't exist for any other precious metal. Silver plays both games, monetary metal and industrial commodity. Both tailwinds are blowing. These aren't predictions based on hope. They're projections based on data that exists today. Numbers already in the system. Flows already happening. Decisions already made by central bankers in Warsaw, Beijing, and Ankara. The clocks are ticking. 150 days on tariffs, 10 days on Iran, both counting down simultaneously. And every day they tick, the case for precious metals gets stronger. You've now seen what most Americans will never understand about this moment. The constitutional crisis in our trade system, the military positioning in the Persian Gulf, the central bank accumulation that's been building for 3 years, the structural deficits in silver supply, the fiscal pressure from $175 billion in potential refunds hitting a Treasury already drowning in red ink. All of it points the same direction. All of it says the same thing. Hard assets, real money. Outside the system, not because the system is going to collapse. It's not. America remains the most powerful economy on earth. Our markets remain the deepest and most liquid anywhere. Our military remains unmatched by any rival. But the rules are changing. The assumptions that held for 50 years are being tested in real time. And smart money, institutional money, central bank money, is adjusting its positioning accordingly. They're not waiting for permission. They're not waiting for certainty. They're acting on the data in front of them. The question isn't whether gold and silver continue higher. The data answers that question. The question is whether you're positioned to benefit when they do, or whether you're still sitting on the sidelines waiting for a perfect moment that already arrived 3 days ago. 2 clocks, 150 days, 10 days, gold blazing past 5,000, silver holding strong above 84, central banks buying, carriers deploying, Treasury scrambling, courts ruling, presidents proclaiming. All of it happening right now, all of it pointing the same direction. What are you doing today?